It is not impossible for others to invest. Regardless of age, it is for everyone. Your money will work for you by investing. It is one method of achieving numerous financial objectives. By investing, you ensure that your money keeps pace with inflation and move closer to achieving financial independence. In today's video, I'll give you some tips on how to invest as a beginner. This video will provide you with some basic educational information so you may begin your own learning and investing journey. By investing, you're putting some of your money to work for you now and later. When you invest, you're making a purchase of something you anticipate gaining value over time. A return from investing could be higher than one from a savings account. Despite the fact that your money is not locked away, you should be ready to lay it aside for at least 5 years to give it the best chance to develop. Additionally, keep in mind that the value of an investment might fluctuate, meaning you could get back less than what you invested. But before considering investing, let's check our finances first. Before you begin investing, you should pay off any unsecured debts that bear interest, such as credit card balances and loans, and start saving money. The following tips will help you to do just that. If you happen to watch my previous videos, I'm sure you're familiar with these tips. 1. Have your emergency fund. Unexpected financial emergencies have happened to all of us at some point, whether it was a car accident, an unanticipated medical bill, a broken appliance, a loss of income, or even a broken cell phone. These unforeseen costs, no matter how big or small, frequently seem to come at the worst moments. One essential strategy to safeguard oneself is to set up a designated savings or emergency fund. You may recover more quickly and get back on track to achieving your larger saving objectives by setting aside money, even a modest amount, for these unforeseen costs. Without savings, even a small financial shock can be detrimental, and if it results in debt, it might have long-term effects. You don't have to replenish your emergency fund all at once with a sizable sum. The amount you require will vary based on your situation. Consider the most prevalent and expensive types of unforeseen expenses you've encountered in the past. This will enable you to decide how much money you wish to set aside. 2. Eliminate debt. Debt prevents you from making the most out of your money, which poses a severe risk to your ability to maintain financial stability. Due to your debt, you are unable to make purchases. As a result, you continue to borrow money until you run out of options. It takes a lot of determination, but paying off your debt breaks this vicious cycle and gives you money to spend on the things you truly like. You must constantly remind yourself of the reasons why you want to pay off your debt if you want to maintain the pace. In what ways would paying off your unpaid debt improve your life? Less spending and more saving are admirable objectives. The secret to success, though, is debt repayment. You'll have more room in your budget to work toward financial security after you're debt-free. 3. Open your retirement account. The majority of people who don't already save think they don't have enough money to cover regular bills, let alone have any left over. Paying oneself should be a top priority though, just like paying others. Defaulting on debts or letting bills go past due is obviously not a good idea, but if you don't take care of yourself, then who will? It's likely that you still have a way to go before retiring, which makes it simple to put off creating a plan of action. However, it might already be too late by the time you retire. If you begin retirement planning as soon as possible, you'll put yourself in the best possible position. Depending on your income, it may take decades to save the money you need for a comfortable retirement. You'll want to have the biggest nest egg possible when you stop earning a paycheck. Early retirement investing will help you build up your retirement savings over the course of your work, giving you a sizable enough nest egg to realize your retirement goals. You may begin creating a retirement plan right away now that you are aware of how important it is. Now let's move to investing. The ability for beginners to open an account on a brokerage website or mobile app with little to no money has made stock investing more approachable. Now, if you're not familiar with stocks, stock market, shares, and funds, let's talk about it first. What is stock and stock market? Stock is an investment that represents a share in the company. As a common shareholder, stock symbolizes an ownership stake in a company. Stocks are regarded as a risky asset that can boost an investment portfolio's growth and yield. This indicates that it is an asset class with a high level of price volatility. Beginner stock investors must take their level of risk tolerance into account. Generally speaking, the potential value of an investment increases with investment risk. However, investors must be prepared to assume the risk of financial loss in the event that large returns are not realized. History demonstrates that over time, the asset class of stocks has consistently provided significant average annual returns. For example, you may purchase shares in Facebook, which essentially means you control a small portion of the company. Therefore, when Facebook expands, your stock will also progressively increase. In contrast, if the company fails, your stock will also slowly shrink. The stock market is the place where equities are traded. Stocks are held in order to display all the various ownership stakes in the company, as well as their overall performance. The stock market is interesting because investors typically have control over it. A stock may be bought or sold only if it is listed on an exchange. As a result, it serves as a hub for stock buyers and sellers. What are funds? A ready-made investment bundle is referred to as funds. When you invest in a fund, you're purchasing a variety of assets, including cash, government bonds, stocks, and real estate. You can avoid trying to choose particular investments that you believe will perform best by using funds. The beautiful thing about money is that it allows you to spread your financial risks. Instead, a variety of investments are made with your money. Diversification, also referred to as risk dispersion, is the practice of doing this. This is so that even if some of the fund's investments perform poorly for a while, others might not. There are two main types of funds. One, an active or multi-asset fund, is run by a professional fund manager who chooses which shares, bonds, or other assets to hold and monitors them on your behalf. You pay extra for the fund manager's expertise with the aim of receiving returns which outperform the market. 2. A passive fund or index fund simply follows or tracks a given market or index. As there is no active involvement from the fund manager, passive funds generally charge less in fees. As you get closer to retirement, your investments could have less time to recover from any dips, so a more conservative fund may be more appropriate. What are shares? Units of ownership in a company are called shares. You essentially purchase a small stake in the company when you buy shares. Companies raise money by selling shares, which they subsequently apply to corporate expansion. Shareholders are then free to purchase and sell any number of those shares at any moment on the stock market. Demand for the company's shares will often rise if it performs well or is anticipated to perform well, driving its share price higher. The share price of a corporation will typically decrease if it performs poorly or is predicted to perform poorly. Share prices can be impacted by interest rates as well as the general economy. The value of your investment as a shareholder changes along with the share price. So, while the money you invest has the potential to grow, it could also decline in value, so you may get back less than you invest. There are two main ways you might make money from an investment. If you're considering funds, this means choosing between an accumulation or income fund. With an accumulation fund, the income generated is reinvested within the fund, meaning your investment will be more likely to grow in value over time. While with an income fund, any income the fund generates will be paid directly to you. If you can invest for growth over a long period of time, it may be a good idea because accumulation funds may yield higher returns in the long run. On the other hand, if you're close to or are already in retirement, investing for income may be a suitable short-term plan. By investing in funds that pay dividends, you may get recurring payments to supplement your current salary or pension. If you're thinking about investing in shares, you must also choose whether your goal is to achieve income or growth. Remember that investing in shares might require extensive research, and to reduce the chance of losing money with one specific firm, you should hold a variety of equities. No investment is without a risk. Although there are no assurances, you are investing your money in something you hope will appreciate in value. You'll be exposed to market risks, which means that the value of your investment may fluctuate, resulting in the possibility that you may receive a lower return than you invested. Risk and reward are indissolubly linked to investment. As a general rule, assets with higher risk, like stocks, have the potential to yield greater rewards. Investments with reduced risk typically provides poorer returns. You can get started with very little money, so dipping your toe in the water by starting small can be a good idea. You can then see how your investment performs, and if you like, make additional investments. Thanks for watching. If you like this video, please click the like button. And if you want to upgrade your life from what you have to what you deserve, click the subscribe button now.